Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
So let's look at some past examples, and I have a current chart of the yuck, the Japanese currency market against the dollar here in just a little bit. But so what we have on this chart is you can see we're looking at in this case the ISE vehicle here just for comparison, EUR, and then in this particular vehicle you can see that. Look at where the potential buy signals are. This is actually taken off of Metastock, and we have a couple different big trends indicators on here. We have the acceleration bands on the upper panel in blue. These are 20-day acceleration bands. So with the 20-day acceleration, that's about the last month's activity here there in blue. Of course, we also have a 200-day that's in purple here, that longer, slower line there, just to show you a little different perspective. But what we're looking at here is a situation in which you can see where's the buy signal on this first one that's happening as we break out there, and then I'll circle it here that the first high has to be taken out, and you can see it's taken out right there as we break out above there. So we're just staying in this overbought zone here. In fact, we're coming in for a retest right on this little pullback. That's the next place where we would tighten up our stop. So, okay, if it closes under that low, we've got to get out. But if we don't close under that low, it could be a great chance to re-enter. And I always get this question, how do you know when it's going to actually hold that retest low or when it's going to break? And my answer, I don't. But what I know is that based on the testing and my own particular experience dealing with this, that if I'm wrong, then I'm going to get knocked out underneath that key support level. In this case, it doesn't take me out. So we keep riding, and in fact, you get another chance to hop on board for the next wave. You can see then that the next time we come back up, test that next level is here in early September, and then, of course, we break right below it, and there's your closeout. So, in fact, that one does violate. So if you get the violation, you must exit first and ask questions later. You don't want to be in a position in which you're saying, well, I'll see what happens. You know, once you get the exit signal, it's time to go. We also, by the way, on this chart have the positive and negative directional movement lines on the very bottom panel there. That's just another indicator some folks like to look at. We'll keep an eye on the directional movement index, the DI, plus DI in blue, the minus DI in red, and the green is the directional the average directional movement, the ADX. So, again, just another tool that you could use. But we're focusing today on %R. So you see, then we kind of go through a little bit of a dead zone. Not much happening through this phase in the middle of this trend here. We don't actually break out again until about mid-September. And so we put our little line there when we go into the overbought threshold. Once we cross over that, the very next bar here, you can see we're getting a new buy signal happening up in this zone. Now you're buying it a little bit higher than the last time you sold it. You've got to get over the fact that that's just part of the way that a good chart structure should work. Is that the next buy signal you should be seeing on a new high rather than trying to buy lower. That the idea is that you want to buy stocks that are going up. The old Will Rogers quote: "If they don't go up, don't buy them." That's really the idea here, is that you're trying to benefit from the next wave. And you can see then where's our next little test back under the 80 threshold on %R, coming right into this little short-term low. Notice how many times you'll see a key low right at that retest point. And in fact, this one gives you multiple retest points along the way here. So, okay, you tighten yet again, and then you can see you keep on tightening each little step of the way. It's like a little stair-step ladder. You just keep on kind of ratcheting up your steps, not every single bar, but on each important retest point. So from my perspective, this makes it much, much easier to follow. And you can see we're just progressively tightening that stop, and then finally you can see where it's going to take us out, right in this zone right here. So it looks kind of nasty on a day-to-day basis, but look at how that trend has changed dramatically. Now on the downside, you can see what's coming here. So we're actually getting now the downside set up, and then it's confirming underneath that low right here. So basically we're breaking our acceleration bands, about 75 on that vehicle. And so basically we have a situation in which, you can see, look at how quickly things drop right back to the 200-day, just a tremendous move. Now, this is where, especially when you're trading FX options, it makes sense to have some other rules in place as it relates to profit targets. We're big believers that if you can get a double in any option, in any vehicle really, then you want to go ahead and take that double on half of your position. We tend to then seek to let the rest of the position ride until it hits that eventual stop out point. So for us, it's a matter of you get that original risk capital back, and then you're able to truly, let the trend do its work. Now you can see as this trend progressed, you can see, of course, we're breaking the 200-day back in, that was May '09, and then basically you can see we're going into another downtrending phase. So what's happening here, as you can see, we're actually breaking down. Took a little bit of time to follow through after that one. You can see then we get our follow through point, and then you can see we get a nice quick rally to the downside. And where's our stop out on this one? Early June. Comes back up, takes out that high, and you say, okay, bye-bye, and you get taken out right there. Fine. Again, you're never going to catch the exact low or exact high of the move with this method, but you're also not going to risk all the difficulties of trying to pick tops or bottoms. Your goal is to take out the sweet spot of the trend. So if you really look at kind of just like highlighting, if you will, the way that these trends are set up, I mean, you can really see, where's the sweet spots, and then you literally can visually go in here and say, okay, that was sure one of the best moves back there in August on that particular phase, and then one of the next moves, of course, was through this next window, September through early November, and then, of course, also catching the big, quick decline that happened in here. So really you're catching several of the biggest and best moves. You're still going to have some trades that whipsaw you out. That's just a fact of life. I mean, let's look at a trade that didn't work here. So, for example, you see where it looks like you get a new sell signal back in August, and you see it looks like we're about to get a pretty nice little signal there. We're breaking down here. It looks like everything's getting ready to go, and then here's your retest coming, and in fact is going to take you out at a loss about a week later. Now that's something that you have to deal with. In RWS, have we tested this method, and what were the results? Yeah, I mean, the results historically on equities, looking back over 10-plus years of data across, thousands of optional stocks, have typically run where the win percentages are not that much better than 50-50. Doesn't sound very good, but the size of the winner versus the size of the loser is in the neighborhood of about 2.5 to 1. So it's like, say, about 52-53% profitable, but then the size of the average winner is 2.5 to 3 times the size of the average loser. That's where we make our money in option trading. So, from my perspective, I'm looking for that speed of movement, and I'm looking for that kind of bigger move compared to a smaller risk, especially off the retest method. The retest method is actually, to me, the best risk-adjusted technique that I've seen out there for really keeping your risk down when you place a trade, knowing that sometimes you're going to have to stop it out quickly, but when you catch it right, you're going to have some wonderful trades that can actually be a lot bigger than the risk that you're taking in any one particular trade. So that's really what we're after when we look at these type of charts. Now here's the yuck from '09, and we're going to go in and look at it in the more up-to-date version through today's action. So again, this is a meta stock, and you can see here that, okay, you have a market that is basically downtrending. Looking at the yuck, the U.S. dollar Japanese yen ratio here, and so you can see that what you're having here is clearly a couple of nice trends amid a couple of choppy trends. That there's one good up phase here on the left side of the chart where we're just breaking out, and then we close above that high. Then we actually get our first retest. It's a little steeper than we would like. You can see in this case, the retest comes in here, and then unfortunately it does take you out, in this case, right at that short-term low. That's one of the cases for you didn't make much money from the beginning to the end of the phase, but there was money there in between. If you can get part of your profits locked in, then basically give it a chance to ride. That's certainly going to be a better, more consistent approach in our experience than just trying to let it all ride up or down. So we're big believers in scaling out of profits as we get them. The obvious best downtrend on this chart was here in the last part of the chart, and you can see it took a couple bars, but on the second bar it followed through and closed below there. And then look at the retest. You get this kind of gap up here. Some of you may notice that little bar is an island reversal, but that's a great spot when you're seeing that sort of flush of the bear sort of racing out of that situation, saying, hey, that's a low-risk retest. And then if you miss that first wave down, you say, look, it gets ready for a real nice second wave down. And you see, okay, even if you're putting a trade on into this next retest, you can see that here in just a few bars, you're going to get stopped out, small loss, and moving on. So that's really the name of the game. That's why I like to wait for the retests and go from there. Now, I've got a more current update. This is actually pulled out of TradeStation here today. And you can just see how volatile the yuck has been with the tragedy in Japan and what's been going on there. And this is a pretty interesting chart because actually as of today, this morning, it was stopping out a bear trade that you can see in retrospect was not a good one. Now this is why I wait for the retest. Here's a great example of it on the right side of the chart. You see the breakdown happening, and so let me just, if I can, there's the breakdown happening, and let me get a different color on here. Let's just go with a little lighter color here. Actually, we'll go kind of pinkish. And so what we're looking at is there's your breakdown, and you say, okay, what's happening from that point on the chart? Well, we started to break down. If any, just on %R, this is also requiring a break below these bands. But, if we just look at the breakdown points happening about in this neighborhood, you can see that's about 81 on the yuck, okay? So there's our breakdown point, and it's feeling pretty good. You're getting this gap down, it's like, wow, we're really shooting down. But if you wait instead and you say, okay, I'm going to actually I'm going to clear those annotations and say, let's go and say wait for the retest. Well, look at where the retest comes in on this one. When it shoots up after it looks like kind of the worst is over, that's even though it's a violent retest, %R comes all the way back up to about the 40 level from well above 20. But that high is now the spot at which I'm saying, okay, that's a good spot to say we should get a good flip back down. In this case, that's wrong. You can see that indeed yesterday's close, we actually finished above there, and so that's why it's saying it closed above there yesterday. So it's saying buy it back on the open this morning. Now, if you're in a put and you did not get a chance to take much of a profit on that, and you're just saying, okay, fine, I'm just cutting and running here. Either yesterday's close or today's open, either way works. You're seeing it close above there late yesterday, saying bye-bye to the trade. Ray is familiar. He said, loves my 30 setting on %R. You can see on this chart that I can kind of help you to say, hey, the 30-bar setting is what I like to use. Doesn't mean you can't tweak it some yourself, but 30 bars has worked very well in my testing across a lot of different time frames. We're mainly focusing here on the daily chart, but the idea is that, you can certainly use this on intraday charts. I'll use an hourly chart for swing trades of 3 to 5 days. I'll use a 15-minute chart for a 1 or 2 day trade. I use the weekly chart for a multi-month trade. So it's one of those things where you just have to look at. Now look at the yuck going back on this chart into the middle of last year, June of 2010, and you can see, look at the breakdown in the %R that was happening. As you can see, there's the break happening right there. We draw our line up, and you can see that basically we're breaking under that low right there, and then we were closing below it the very next bar. So that's where we're getting a bearish signal on the yuck. Let's talk about the options for just a minute. So remember I mentioned that that's about 90 on the yuck. So I would not buy a 90 put in any expiration in my personal way that I trade. I would be looking for a 92 put, a 93 put, something that's got a good amount of intrinsic value. So say you buy the 93 put when the yuck's at 90, and you say, okay, if we're buying that 3-point in the money put, then you're saying, okay, that's a situation in which we say we'd really get an immediate 3 points of intrinsic value. And let's say you pay $4 for it. Say you buy the even let's say the August 2 months out put. Well, you buy a 93 put, yuck's at 90, and you pay 4 for it. So one of those 4 points is time value. The other 3 points is intrinsic value. That's 75% intrinsic. And so in my world, that's an example where you say, okay, look at how many times we can ride, how many times we can adjust. You get the retest coming in here. There's your next key closing stop. It doesn't take that out. And you just get retest after retest here. It keeps coming in and telling you to hang in there on each of these tests. So you keep seeing these things happen. You say, okay, I'm hanging in, and you see all these points along the way. We just keep on getting more and more resistance points and more examples of how we're not getting flushed out of the trade like everybody else. So the dollar value of your option position, if you bought the $400 per contract example I was just sharing with you, is a great example because, okay, so you buy one contract, it gives you the right to sell yuck at, say, 93. It's already at 90, so it's worth $300 intrinsically on that 100 shares. Well, then basically you're saying, okay, but you paid $400 for it. Well, why would you do that? Because you think that it's got a lot more than another point of downside. You think it's got many points of downside. In this case, even up until about the mid-August expiration, you can see the yuck finishes somewhere in the neighborhood of about 85.5. So even call it 86 for a round number. You've got a 93 put. It's at 86 at the expiration. That's worth what? It's worth that 7 points, $700 a contract. You paid $400 for it. That'd be a 75% gross return. So that's an example of how steadily how you can ride these things along the way. So, but the principle here is that the last trade you can see, if you waited for the retest back up just under 82, well then you might be buying an 84 put, and then now you're taking it out when it's closing yesterday just over 82. So it's an example where you're not going to lose a whole lot of time or relative price action. There's always gap risk. So, you can't say that you have no risk. You have some risk. But the idea is you want to keep your risk as tight as you can while letting your winners run, like in the case of yuck back last summer. So that's an example of what we're looking for.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.